Imagine a world where spending a few dollars today could silently chain you to years of financial stress tomorrow. Sounds extreme. Well, that's exactly what credit cards do to millions of unsuspecting people every single day. You swipe, you spend, and you think it's all fine. But behind the shiny plastic lies a system designed to keep you paying more than you realize. Welcome to the hidden financial trap most people never see coming. Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. It all started decades ago when banks realized that people were willing to pay a small fee to borrow money instantly. Before that, borrowing was complicated, formal, and time-consuming. You had to visit a bank, fill out endless paperwork, and sometimes even pledge your home or savings as collateral. Then came the credit card, a simple, shiny card that promised freedom, convenience, and instant purchasing power. The first widely accepted credit card in the US was introduced in the 1950s by Diners Club. It was a revolutionary concept. Instead of carrying cash, people could pay for meals, travel, or shopping with a card, and settle the bill later. At first, it was a small, elite club, mostly for wealthy professionals who traveled and dined out. That's exactly what they want you to believe. But consider this. More than 40% of Americans carry credit card debt every month. How did this happen? How did a simple convenience turn into a financial trap? The answer lies in the psychology of spending and the structure of modern credit systems. Banks realized that if they could make borrowing feel invisible, like swiping plastic instead of handing over cash, people would spend more freely. And spend they did. By the 1980s, credit cards were everywhere. Stores advertised no money down, and buy now, pay later. People were told that carrying a balance was normal, even smart. Rewards programs emerged, points, miles, cashback, little incentives that distracted you from the bigger picture. See, they said, you're earning money while you spend. But in reality, most people were earning rewards while paying huge amounts in interest. Think about your own habits. How often do you buy something small, like a cup of coffee or a gadget, and swipe without thinking? Now imagine that multiplied across millions of people. That small swipe becomes the first domino in a chain reaction that can take years to correct. The system thrives on what economists call minimum payments. You're shown a tiny amount to pay each month, just enough to keep the account current. In some cases, a $1,000 purchase can take 20 years or more to pay off. 20 years, and by the end, you may have paid 2 or 3 times the original amount. Why give you helpful minimum payments? The answer is surprisingly simple: profits. Banks make more money from interest than from fees or other charges. Every month you carry a balance. Every month you don't pay in full, you're feeding the machine. It's not malicious, it's just business. But the consequences for ordinary people can be devastating. Before credit cards, people mainly borrowed through loans with fixed terms. They knew exactly when the debt would end. And this is where many people first encounter trouble, without even realizing it. Consider the story of Jennifer, a single mother in Texas. She started with one credit card for emergencies. Then she added a second for travel rewards. Before long, she had 4 cards, each with different balances and interest rates. The minimum payments seemed affordable, so she never panicked. Jennifer's story is not unique, it's a pattern repeated across millions of households. Banks also use clever psychological triggers to encourage spending. Think about the advertisements you see: buy now, pay later. Flexible payments, exclusive offers just for you. Each message makes borrowing feel normal, exciting, or even beneficial. Combine that with social pressures, friends, family, influencers showing off lifestyles, and the result is a perfect storm of overspending. You might be wondering, is it really that bad if I use my card responsibly? Let's talk about fees. Late fees, annual fees, balance transfer fees, foreign transaction fees, the list goes on. Each one may seem small individually, but over time, they accumulate. And some credit card contracts are so complex that even savvy users don't notice every charge. Here's a twist you may not expect: the system isn't just about individual spending. Credit card debt is a huge part of the national economy. Banks and investors package these debts into securities and sell them on global markets. That's right, your unpaid balance might end up bundled with thousands of others and traded as an investment. The bigger the debt, the bigger the profit for the financial system. And this was one of the contributing factors to the 2008 financial crisis. Back then, millions of Americans defaulted on loans and credit balances, and the ripple effects spread worldwide. The system that once seemed convenient revealed its darker side: interconnected debts, risky lending, and complex financial products that few people understood. And even after the crisis, the underlying mechanisms of credit card debt remained largely unchanged. Credit card debt in the U.S. recently surpassed $1 trillion. That's a staggering number, and it's growing. Meanwhile, banks continue to innovate, introducing rewards, buy now, pay later options, and ever higher limits. On the surface, it seems helpful, but underneath, the trap remains. The question is, why do people keep falling for it? Partly, it's human nature. Instant gratification feels good. Spending now and worrying later is tempting. Partly, it's lack of financial education. Schools rarely teach the intricacies of interest, compounding, and debt. And partly, it's the system itself designed to make borrowing feel invisible and easy. You may be thinking, can't I just avoid credit cards altogether? Credit cards can be useful for building credit, making online purchases, or covering emergencies. The key is awareness, understanding how the system works, knowing the cost of interest, and being disciplined about payments. Here's a practical example. Imagine buying a $500 laptop. If you pay it off in full within a month, you owe nothing extra. But if you make the minimum payment of $25 each month at a 20% interest rate, it could take over 2 years to pay off. By the end, you'll have paid nearly $600 in total, $100 more than the laptop cost, just for borrowing. Multiply that by multiple purchases over time, and you begin to see how quietly, gradually, debt accumulates. The system is also designed to catch you when life happens. In those moments, a card feels like a lifeline, but it's actually a trapdoor. Many people enter cycles of rolling balances, minimum payments, and accumulating interest without a clear exit strategy. Some solutions have been proposed over the years, like capping interest rates or stricter lending rules. Yet, most attempts fail because the financial industry is highly profitable and influential. The underlying incentive remains: encourage borrowing, make repayment confusing, and profit from those who carry a balance. So what can you do? First, awareness is critical. Understand your interest rates, fees, and minimum payments. Second, prioritize paying off high-interest balances first. Third, consider alternatives for large purchases, such as saving up or using 0% interest promotions wisely. Knowledge and planning are your best defenses. It's important to remember, credit cards themselves aren't evil. They're tools. Like any tool, their impact depends on how you use them. Swipe thoughtfully, pay in full when possible, and treat borrowing as a serious commitment, not a casual convenience. To put it in perspective, think about the thousands of small decisions you make each year: coffee, groceries, online shopping, all adding up on credit cards. Individually, they may seem harmless. Collectively, they can create a financial burden that's invisible until it's overwhelming. And here's a final twist to consider: the system repeats itself. Historically, Americans have cycled through debt crises: 1910s installment buying, 1950s credit cards, 2008 financial crash, and each time, patterns repeat. Awareness, education, and careful planning are the only ways to avoid being caught in the same trap. So, what are the key takeaways from this deep dive into credit card debt? First, always understand the cost of borrowing, including interest and fees. Second, avoid minimum payments unless absolutely necessary. They extend debt and increase interest paid. Third, use credit cards as a tool, not a lifestyle crutch. Awareness, discipline, and education are your shields. The hidden truth about credit cards is simple yet shocking: convenience comes at a price, and many people pay it without even realizing it. The system is clever, the incentives subtle, and the consequences serious. But with knowledge, vigilance, and smart financial habits, you can navigate it safely and even benefit from it. As you reflect on this, ask yourself, are your purchases empowering you or quietly tying you down? Understanding this distinction could save thousands of dollars and years of financial stress. Remember, the more you know, the less likely you are to be trapped. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.